Imagine waking up knowing you're financially secure, having enough to retire young, or just crush your financial goals. Most people want to be rich, but very few actually know how to build wealth. In this video, I'll give you a full roadmap. No hype, just a plan that works. Now let me ask you something. If you want to build wealth, would you rather have all the world's knowledge instantly available at zero cost? Of course you would. Well, that's exactly what you're getting. First, let's talk numbers, because numbers don't lie. They tell the story of your financial life. So here's the real wealth formula. Wealth equals times time. Yeah, we know that. But here's the secret. Building wealth is mastering these three components: earning more, spending less, and time. All three are equally important. So let's start with spending less. I want you to think about your budget, not that word again. Trust me, your budget is your secret weapon in the game of financial freedom. We'll make it simple. I want you to track where your money goes for 2 months. Yes, 2 whole months. Track every single penny. Categorize your expenses. This isn't about deprivation. It's about awareness. Here's a basic structure. 60% on needs, 20% on wants, and 20% on savings or investing. Think of it like this. 60% is non-negotiable. These are your core essentials, the bare necessities: shelter, food, utilities, insurance, debt payments, anything that keeps you and your family going. Then there's 20%. These are your wants. That new pair of shoes, that streaming service you barely use, eating out those little luxuries that make life a bit more fun. And finally, there's 20%, the magic of savings and investing. This is where things get interesting, because while it might seem like a lot now, remember the formula. Wealth equals earning minus spending times time. Now let's talk about saving and investing. Why is it important? Because you never know what's around the corner. Sudden car repair, unexpected medical bill, or even job loss. Life has a funny way of testing you when you least expect it. And that's where your emergency fund comes in handy. Before you invest a single dollar into stocks, real estate, or any other investment, build yourself a solid safety net. The rule of thumb is 3 to 6 months of your living expenses. In other words, your emergency fund should cover your essential costs like mortgage payments, groceries and utility bills for 3 to 6 months if you lose your job, face a medical emergency, or experience any other financial setbacks. This acts as a cushion between you and your longer-term financial goals. Here's the truth. Your emergency fund is not for investing or taking vacations. It's there for unexpected situations. Once you've got your emergency fund sorted, it's time to start investing. Now you might be thinking, stocks, bonds, mutual funds, oh my. Don't worry, I'm here to simplify it for you. My go-to recommendation is a broad market ETF. These ETFs track a wide range of companies and markets. For example, the S&P 500, you might have heard of it. One such ETF is VUAA or VUSA. VUAA covers the US market and VUSA covers the global market. Why do I like them? Well, first, they're diversified. Imagine owning thousands of companies with just a few clicks. That's what ETFs offer. Second, they're long-term focused. We're talking decades, not weeks or months. And third, they're backed by history. Since 1950, the S&P 500 has delivered an average annual return of around 7.7%, not including dividends. Plus, its compound annual growth rate is approximately 10.5%. This means that on average, the index has grown by about 10.5% each year over the long run. Remember, past performance is not indicative of future results, but it gives us some sense of stability. Now let's talk about how much you should invest. There's no one-size-fits-all answer, but I recommend aiming for that 20% savings rate we discussed earlier. Next, let's discuss when you should start investing. Spoiler alert, it's not as complicated as you think. Dollar cost averaging, or DCA for short. It's not a fancy investment strategy. It's just investing a fixed amount at regular intervals, say $100 every month. By doing so, you buy more shares when prices are low and fewer shares when prices are high. DCA helps you ride the waves of market fluctuations, making it easier to stay invested for the long haul. Here's the best part about DCA. It takes the guesswork out of investing. No more trying to time the market or wondering if you're buying in at the right moment. Just stick to your plan and keep investing consistently. Here's something else to consider. Research suggests that attempting to time the market rarely pays off. According to a study by J.P. Morgan, had investors simply stayed in the market during the same period, they would have earned far more money. On average, the best performing day of the year happened more than half the time in the last 20 years, underscoring the importance of staying invested. I want to emphasize that investing involves risks. The value of your investments can go down as well as up. However, if you stay invested for the long term, ride out those ups and downs, you can harness the power of compounding interest. It's like earning interest on your interest. Over time, it can turn your initial investments into substantial wealth. Patience is key in investing. Resist the urge to chase quick returns or make impulsive decisions based on market sentiment. Look at Warren Buffett, one of the world's most successful investors. He's known for his long-term perspective. Buffett doesn't panic when the market dips. Instead, he sees it as an opportunity to buy good businesses at lower prices. Remember, wealth is built by being patient, not perfect. Most people give up too early. Don't be one of them. Stay consistent. Let time do the compounding. If I were starting today, here's exactly what I would do. 1. Track my expenses. Get a clear picture of where my money is going. Use apps or spreadsheets to categorize and monitor spending. 2. Build a safety buffer. Start with an emergency fund. Aim for 3 to 6 months of living expenses. This provides a financial cushion for unexpected events. 3. Open an ETF account. Open an account with a reputable brokerage platform. Choose a broad market ETF like VUAA or VUSA. These ETFs provide diversification and long-term growth potential. Consider opening a Roth IRA if eligible. It's a great way to start investing and benefit from tax advantages. I'll leave a link in the description below. 4. Automate monthly investments. Set up automatic transfers to invest regularly in the ETF. Start with a monthly contribution that fits your budget and increase it over time. 5. Stop chasing headlines. Avoid making investment decisions based on news headlines or market sentiment. Stay focused on your long-term goals and the power of compounding. You ready for a real-life example? Let's say you invest $100 a month in a Roth IRA. Over 30 years with an average annual return of 7%, your investment could grow to over $1 million. Imagine retiring with that kind of nest egg. And now it's time for a bonus. Yes, it's real, and I've done it myself.
Yes.
If you found this helpful, give it a like and subscribe. Every week on Time to Compound, we break down money and investing without hype, just real clarity. Thanks for watching. Till next time.